A company that is indispensable to 99% of the world's smartphones must be a target for any investor. Arm, the global UK-based semiconductor giant, is one such company. Following the resounding success of Arm that followed its most recent earnings report, SoftBank's shares in the company exceeded its own market cap, offsetting losses from many bad acquisition deals it has been recently involved in. What was the reason behind this success, and will it be a one-time thing, or should investors immediately jump on the Arm SoftBank train? In today's video, we are going to take a deep look at both companies' histories and future prospects in light of recent events. Welcome back to PST Markets. Arm is a UK-based semiconductor company owned by SoftBank. You might not know what kind of product the company specializes in, but you probably use it all the time. In fact, Arm's products are among the most widely used worldwide because the company designs for almost 99% of the world's smartphones. Long story short, it is responsible for designing Arm-based chips that are used to build mobile phone processors. The company typically makes money through royalties, which means that chip manufacturers pay a price to be permitted to build Arm-compatible chips. Arm is an indispensable manufacturer for Apple, Samsung, and many other mobile phone giants. It has also collaborated with Microsoft and other tech giants. It's also worth noting that the company produces many specialized products that aren't meant for incorporation into popular consumer products. As an investor, you don't have to worry about the technical details of any of its products. It is enough for you to keep in mind that its unwavering relationships with multiple tech giants and its domination over the mobile phone industry is a testament to how efficient and cost-effective its products are. Arm was a public company until 2016 when its relationship with SoftBank began after the Japanese company acquired it for $32 billion. At that point, Arm had been a hot commodity for decades as the smartphone industry was booming. But this doesn't mean that the company never faced challenges at certain points. As is the case with almost everything, the smartphone market began to slow down. This was mainly for two reasons. First, consumers started keeping their mobile phones for longer. New tech features were no longer as enticing to consumers as they were back when the smartphone industry was in its infancy. Everybody was obsessed with the rapidly evolving new technology. Second, it can also be that some macroeconomic trends, like rising interest rates and the correlative fall in consumer spending power, had a negative impact on the company's sales record. In any case, Arm stumbled in the fiscal year ending on March 31, 2023, when its sales slipped 1% to $2.1 billion. It may not seem like a significant number, but it was a notable change for a company that had been growing for quite some time. Moreover, the trend continued, and sales fell 2.5% in the next quarter. In 2022, SoftBank agreed with Nvidia to sell Arm for $40 billion. The deal was going to be the absolute biggest in the semiconductor industry's history, not only due to its size but because of the groundbreaking transformation of the market that would have resulted. As we have already seen, Arm has a virtual monopoly over CPUs regarding smartphones. Combine that with Nvidia's deep involvement in the GPU sphere, and you have got a beast controlling most of the semiconductor industry. At least that was the argument that led global antitrust regulators to stop the deal, which eventually fell through in February of 2022. The next major development in the SoftBank Arm story is the IPO of Arm in September of last year. It was the largest IPO in the last 2 years at the time, and company shares rose 25% on the first day, leaving Arm with a market cap of around $65 billion. SoftBank owner and CEO Masayoshi Son led the IPO. They were optimistic that the company would heavily invest in AI in the near future, promising that ChatGPT-like services would eventually be able to run on Arm-based processors. Given the recent AI craze and the desire of many manufacturers to be able to run AI services on their chips, Arm has significantly bounced back from the not-so-stellar 2023 fiscal year. It also helped that the smartphone market has been recovering and is on the way back to fast expansion, at least for now. With that picture in mind, we should not be surprised when we look at the sweeping success Arm has seen in the last few days since its latest earnings report became available. Arm reported fiscal third quarter earnings last Wednesday. The company beat all estimates for this quarter and expects even stronger profits to be reported in the next fiscal report. Arm's earnings per share were at 29 cents adjusted, an improvement compared to the expected 25 cents that was based on consensus estimates from LSEG, formerly known as Refinitiv. As for the total revenue, the company beat expectations by 8%, reporting $824 million as compared to the projected $761 million. The company reported a net income of $87 million, which is 8 cents per share. As for a general overview of its recent performance, it is notable that revenue increased 14% compared to the previous year, reaching a value of $470 million. In addition to the aforementioned growth in the smartphone market and the excitement over AI, the company also attributed this improvement to automotive companies and cloud providers. ARM has also been bold in terms of its future expectations, which further encourages investors. The company expected earnings per share for the current quarter to be between 28 and 32 cents and sales to lie between $850 million and $950 million. This is notably higher than most analysts' estimates, who expect earnings of 21 cents per share and sales of $780 million. The company's justification for these expectations is the projected growth of royalty revenue, which has already seen a year-over-year increase of 11% to a total of $430 million this quarter. The company also emphasizes its licensing business, which makes it easy and cost-effective for manufacturers to produce chips, as they only need permission to use a ready-made design. Such permission is usually bought at an affordable price relative to the cost of manufacturing the chip itself. Investors were excited to hear the promising news, and that accounts for the astonishing surge ARM stock has seen in the last 2 days. The stock closed at $77 this Wednesday, which is already 5.5% higher than its IPO price. But this was only the beginning because on Thursday, the stock soared a whopping 56%, sitting at approximately $120. This is by far the highest value it has ever reached since the IPO. The impact on SoftBank was no less significant. The Japanese company owns around 90% of ARM, or exactly 929.7 million shares. As a result, the value of SoftBank's stake increased by nearly $23 billion in a matter of minutes, boosting the overall value of SoftBank's ARM position to $94 billion. That is dramatically higher than SoftBank's own total market cap of $66 billion. While SoftBank routinely trades at a discount to its underlying net asset value, the surge in ARM's shares seems likely to drive up the stock when trading starts in Tokyo. Based on ARM's steady growth and recent success, and given how dependent most chip manufacturers are on its products, we probably shouldn't expect the company to fumble anytime soon. Similarly for SoftBank, although its overall path has been a little bit more shaky, it seems that its ownership of ARM will keep it floating and even rising for the time being. It's likely that ARM is a safe long-term bet for investors right now, and SoftBank will consequently continue to shake up the Japanese stock market. That's it for today's video. What do you think about both companies? Will they keep on growing, or can you think of something that's likely to stunt their growth in the near future? Please share your thoughts with us in the comments down below. And don't forget to like the video and subscribe for more content like this. See you in the next video.